Welcome to the AICPA Town Hall Series, your resource for the latest news and updates on pressing issues facing the accounting profession.
Good afternoon and welcome to the AICPA Town Hall. I'm Eric Auskerson, one of your hosts for today. We've got a very timely show for you. We're going to be kicking things off with the IRS National Taxpayer Advocate, Erin Collins. And as some of you may have seen, the IRS strategic plan came out today on how they're going to be spending that $80 billion. It's 150 pages. So we'll be getting into that with Erin, and Jan Lewis will be leading that opening section. We're then going to have a DC and Profession News update with Barry Melanson. And then we're going to have Carrie Hipsback providing us the technical update section. And we'll close with the open forum and closing remarks. So here's our lineup for today. I'd like to bring up Jan Lewis and Erin Collins. Jan, it's great to see you. Erin, great to see you as well. Our town hall audience, Jan, knows you very well. I mean, you and I were just talking. This probably is your fourth or fifth town hall, so many of them know you, but just let me give a quick introduction. Jan is a great volunteer and leader for the profession. She's the chair of the AICPA Tax Executive Committee. This is the senior committee that oversees all tax activities for the AICPA. And Jan is a tax partner in Haydex Reed, a top 500 in the U.S. Mississippi-based firm. So Jan, thank you, and I'm really looking forward to this next section.
Thanks, Eric. I appreciate you and the town hall audience, and appreciate the IRS putting out that strategic plan about an hour ago. So a little less than an hour ago. So we're not going to go through everything, but you want to go ahead and get started with Erin? Okay. Let me introduce to the audience, for those of you who don't know, Erin Collins is joining us today. She is the National Taxpayer Advocate. Erin started this job in March of 2020, which is just perfect timing, as she will tell you, for everything that she's been through and that we have been through as practitioners. But for those of you who don't know, the Taxpayer Advocate Service, or TAS, it is an independent organization within the IRS, really dedicated to resolving problems of individual and business taxpayers and looking at systemic problems within the IRS. Erin's got great experience in international public accounting firm and with the Office of the Chief Counsel before she took this position. And I know we look forward every year to her annual report to Congress and also her blogs that really usually summarize some of the same issues that we deal with. So Erin, let's dive right in. Thank you so much for joining us and being with us today. Are you ready for a few questions?
I am ready.
Okay. Yes, we'll talk about the $80 billion in the strategic plan. We've got a couple of questions before that, though. So I guess the first question would be, what's on your mind? What's your overall impression? What is keeping you up at night with things at the IRS? I know as practitioners, the backlog, obviously the Inflation Reduction Act, the Employee Retention Credit, K2, K3, pass-through entity compliance regimes, all of those are top of mind for us. Tell us a little bit about what your impression is on the state of the IRS and the tax administration.
Yeah, it's kind of interesting. We're having the town hall today. There's a lot of buzz in the building here as they just released the strategic operation plan. So I've kind of gone a little bit full circle in the sense of, as you pointed out, I started right at the beginning of the pandemic. So at that point, things at the IRS got worse than they ever were. And as most of your members have experienced for the last 3 years, it has been a very tough 3 years. And the filing season, which is in essence the IRS's core mission, that has really struggled. So everything from timely payments to mounds of paper to all sorts of challenges. And you guys have been very vocal as well. We have a lot of similar kind of concerns over the years. And the backlog, it's kind of, I've joked recently that I'm hoping in the year 2023, we stop using the word backlog. That is my goal. And if I were to have one wish, it is to have the IRS get current. So if we fast forward to our current filing season, we are in a substantially better place than we have been for the last 3 years. On one hand, we had a very low bar, so it's not saying a lot, but we are closer to pre-pandemic levels. So if you are filing an electronic return, we're seeing most of those. I think the IRS says 2 to 3 weeks, but most people are getting refunds as long as there's not a problem, usually about a week that those go out the door. Paper, we're probably looking at 4 to 6 weeks, which is remarkable because a year ago it would have been in excess of 6 months. So they really have come a long way with respect to what I would call the normal cases. The challenge still is on those that have issues. So if it is a processing reject, unpostable return, potential ID theft, those are all being delayed. So those are what I would call this year's backlog. There's a big chunk of those, many millions that are still sitting out there. And the big challenge I think a lot of people are talking about are amended returns and correspondence. And again, those are in the multiple $1 million, range. Or not $1 million, million number range. So those have been tough. I think IRS, if you go to their operation page, it says that amended returns are taking, I think it's in excess of, 4 months. I think we're seeing far in excess of 4 months for the cases that come to TAS. So that is a real challenge. I've been pretty vocal. It's been great because hopefully on the practitioner line, you all have experienced the same increase in telephone service. There's a lot less time in the wait. There's been better responses. But as a result, we aren't all paying the price because those folks are answering the phone. They're the ones that normally work the paper, correspondence, the amended return. So unfortunately, we're borrowing from Peter to pay Paul. And as a result, the paper is starting to bound. And I'm getting very concerned that we do not want to end up in a backlog. So I have been discussing a lot within the building that we really need to free up some of those people. It's great they're answering the phones. It's great we're doing better, but we cannot get back into that paper backlog.
I really appreciate that you mentioned it is not just about tax returns, it's about correspondence. And I think the folks that are on this webcast every other week, that is one of our pain points as well. Just the never-ending cycle of correspondence, as Barry Melanson sometimes says, it just doesn't seem to end. So we'll hit on that in a minute, and we'll also hit on that when we talk about the funding piece. I do want to make sure our audience knows that after April 18th deadline, the AICPA does always deploy its annual IRS service survey. Right after busy season, we will have that survey. Also be looking for that. We do want to hear, what our members say, and we of course share that. So the IRS and so we as a profession know what the hot topics are. Erin, I was going to ask, and we'll talk about the backlog. We're concerned. Are the improvements only temporary? Are they only because we did hit rock bottom, or are they real? I think that's a concern among practitioners. And then just about the backlog, let me throw a couple of ideas at you and see your response to this. We know there's always going to be an inventory of backlog. We know that, and that word will still be around. What we don't know is how healthy levels are being defined, and when will we know that we get to those healthy levels? And how are you guys measuring that? It seems like a lot of the measurements do have to do with how many returns are in the backlog, but what about correspondence? And then I was also going to ask you about the practitioner priority line. Yes, we're seeing a little bit of an improvement there. What are you hearing about that? And then the TAS backlog. How is your office's backlog? So just give me a few details that you have on the processing backlog.
There's a lot of questions, so I'll see if I can get a few of them. I'll start at the end, TAS. Unfortunately, we've had the same challenges. We have the downstream consequences of IRS problems. And since you had tens and tens of millions of taxpayers with problems, our inventory was sky high. We have not been as responsive as we would like to be. We have struggled. We've had the ability to hire new folks, get people in the door. We're trying to get them trained quickly, get them on the floor to, start working cases. So we are better, but we are certainly not where we need to be. Our inventory is getting lower per case advocate, but again, we are not that quick response that I think TAS was always known for. That is our goal. We have a pretty aggressive hiring plan in place for the next 3 years. So I'm hoping 6 months from now, we're going to be in a better place than we are today. So it's incremental changes. I call it baby steps. And I'm hoping to the point where that baby is going to be running in the next 6 months. So I'm hopeful TAS is going to get better. On the backlog, I mean, IRS has historically always had inventory. But to me, the inventory is a little bit different than backlog. Backlog tends to be, it's sitting there for long periods of time. So, again, I think part of the challenge IRS is having is in hiring. Some of the backlog is caused by business, whether it's business returns, business correspondence, amended returns. They don't have the same number of customer service representatives or agents that are trained in business. And business, as you all know, take a little bit longer to train folks than just a 1040. So my concern is we're starting to see a shift towards an increase in inventory or backlog on the business side of things. So that is something I am concerned about with respect to this particular year. So, again, I think they're doing pretty well on hiring and getting folks in the door, and again, getting back to the good old days. And I know we're going to talk about it a little bit, but the $80 billion, I mean, the huge difference for that is IRS has never had long-term funding. So to be able to plan not just 1 year under an appropriation budget, but to be able to look forward is really an exciting time to be sort of at the beginning stages of that.
So I know you mentioned the plan, and one of the bullets I took away from that plan as I read it very quickly was about obviously enforcement. The AICPA has made comments over and over again about the balance of funding, but with respect to the enforcement piece, there's a specific comment in there about increasing enforcement of things like employment tax returns and excise tax returns that have not had the coverage. So that brings me to the popular topic on the town hall, and that's the employee retention credit. As CPAs, we have helped for it to be a lifeline for a lot of small businesses who deserved it, needed it, applied for it, are getting the money. Some are still being held up again because of a backlog issue. But meanwhile, we're also in a really tough place between clients and promoters. IRS has done a good job of putting a lot of press out on, pushing preparers and pushing businesses about being responsible for this, but it really does put us in a difficult spot when we have a taxpayer that maybe we do have some concerns about, that they succumb to a marketer. Then we have to deal with the employee retention credit and our professional responsibilities. What are you hearing? I know there's a few criminal cases out there, but there's a lot of employee retention credit going out. And are we going to see anything? What should clients and CPAs expect to see from the IRS?
Yeah, I think you kind of summarized it pretty well. It is a real challenge. I mean, tax professionals are instrumental in getting tax administration done. Without all of you doing your fair share, so to speak, I don't know how the IRS could do their job. And this is a really interesting issue because it's something Congress was really trying, through COVID and other challenges, to get folks this additional money, get it quickly, try and get them in a better position due to loss of business and other types of things. But what we've seen, and I've heard a lot from practitioners and other folks, is there appears to be some, let's just say, puffing, fraudulent, pushing the edge. And you all are partially the gatekeepers for us, because by really working with the clients and telling them what they should or shouldn't be doing, it's fallen on your shoulders. And I think that's put CPAs in a very difficult position, or enrolled agents, because if you turn the client away, they're going to go down the street and potentially you're going to lose business. If you file those returns knowing there's a problem, that causes everybody a problem. So it's been a very difficult time, I think, what I've been watching from practitioners. There's a lot of very legitimate claims out there, and part of the challenge is those have been slowed down because the IRS is trying to, parse through which ones appear to be more aggressive and maybe not proper versus which ones are. So it's been a problem, I think, for practitioners, and it's a problem for taxpayers, because I think some of them are getting pushed into doing things that maybe they're not entitled to. I'm going to give them the benefit of the doubt. They don't understand the legal technicalities. And it also puts big onus on the IRS to figure out what do we do with these things. So it's been, I hate to use the, the saying of it's kind of like all stars are aligned in a bad way here. So they've hit the trifecta in a negative way.
Do you think that there is going to be a focus at the IRS on this as time elapses?
There's a lot of discussion in this building and even with Treasury as to two things. One, making sure people get the payments more timely, because that's a challenge. But also, two, what do we do with the ones that we don't believe are appropriate? So there's been a lot of discussions right now.
And that does bring us to the $80 billion appropriation with the Inflation Reduction Act. I know we have a new commissioner. We have this plan that just was released. The AICPA, again, issued our comment letter a few weeks ago on some of our thoughts. From your standpoint as a taxpayer advocate, what are some of your priorities from your perspective? And of course, you've talked about training staff at the IRS, and this report does discuss hiring more and more folks at the IRS. Will they be able to hire and train the staff that they need?
Yeah, I think it's a long-term plan. I think it's going to be easier to hire and train folks in the filing season, some of the basic type things. If you're looking to audit the Fortune 50 companies, that's a different type of skill set that they need to hire. So I think for IRS, those are going to have additional challenges. But the majority of IRS employees, they seem to be doing, pretty good at getting those folks in the door. And it is, again, this is kind of a once in a lifetime thing for the IRS. We've all been very vocal, you all as well, as to how IRS can do things better. And what has been, kind of fascinating for me sitting in this chair since actually even before the legislation was passed, we started having these discussions. So we've been talking about this plan for minimum, 6-7 months at this point. And what I'm happy to see is a lot of the things that, my office has been pushing, not only for the last 3 years, but almost for the last decade, you'll start seeing those things popping up throughout the plan. So needless to say, wearing my NTA hat, I focus on service and IT, because to me, IT is a huge portion of whether or not we can do service well. So that's really been my big focus. And you'll see a heavy piece of the plan is really looking at the service piece, because those are things that can do a lot quicker than the long-term enforcement of high net worth individuals. So you're going to see a lot of simple things that just would be like answer the phone, be able to return mail, scan things. Let's, get rid of that mountain of paper. Let's get everything digitalized into the system. A lot of it looks like just basic good quality service. One of the things I've been pushing since the day I arrived, I kind of call it the baby I didn't give birth to, which is online accounts. If you truly have a robust online accounts for individuals, but more so for businesses and practitioners. So imagine if you could actually go into one place and see every one of your clients' information in your portal that you have on your online account. I think that's a huge game changer for practitioners. So a lot of the things that we have been pushing, I think, is getting close to reality, which is kind of exciting to see. Needless to say, we're going to have to hold the IRS accountable. We're going to have to make sure that we, push them through and get, proper measurement of success. But when you look at the list, there's a lot of things in there that are just good common sense with respect to service, and then the IT that goes with it.
Well, we like common sense. I think Eric and Barry Melanson are going to join us now just for a few minutes before we let you go. So obviously we have the report. Barry, you heard Aaron call us the gatekeeper. So I'm sure, I don't know if you smiled or frowned when you said that. So I'll turn it over to you guys if you have any questions or comments for Aaron before we let her go.
Yeah, I'll take a shot at that, Aaron. First off, you need to be applauded for your work, and also you mentioned it in your opening comments about the work that you do with us, and not only you in this role, but the office in its history, our team has always worked very closely, and we try to be as constructive in our recommendations as we possibly can. I do, and I really appreciate your, the ERTC issue and acknowledging the sort of the rock and a hard place, because our members take their fiduciary and trust roles very, very seriously, and we also took very seriously the notion of what we could do to help small businesses coming, into COVID and then coming out of COVID. And I just hear it from so many members. It's just a very frustrating situation. So I think as much as that the IRS can push that and make it public and give some cover, if you will, to the people who are trying to do the right things, I think is a very critical item. If I could just add two other things in the plan, I did note the new commissioner's quote related to the release in some of the places about, systems are take a long time to evolve and get in place, but that is obviously part of the system. We are 100% behind you on the portal idea, because the notion of being able to self-serve and deal with these issues more effectively, it's a win-win for everybody. And with that in mind, we are advocates for some other things that can be streamlined, like the extension process, even the payments with extensions. We have some of that takes legislation, but we're trying to balance the cash flow issue, but with how these things can actually happen and make it easier for taxpayers to comply, easier for preparers to deal with this issue, the crunch that occurs at the due dates. We really think if we can take a systematic look at those things and be practical, as Jan indicated, we can make a difference together, and hopefully we can have that continuing dialogue.
I think the IRS is being very vocal about welcoming comments. The report, although it's 150 pages, it is more high level in the sense of, there's a lot in there that they're covering. And it's been interesting having these discussions. Pretty much nothing is off the table. And I think they really are going to be looking for the next few months from comment and feedback from folks such as the AICPA, because, this is sort of this is where our vision is, but that doesn't mean it can't be tweaked and changed. And, again, I think for the first time ever, IRS has money, and that makes a huge difference on how you can plan. So I think it's going to give the IRS the possibility of really coming up with different and novel ideas as to how we can do things better. And I think from the meetings I've been on, they are listening. They are hearing what you all are saying, and they're trying to figure out how do we incorporate that and how do we do things better. So they've been pretty robust and interesting discussions we've had for many months. But the takeaway I have had is I haven't heard no, where historically it was great idea, don't have the money. Great idea, don't have the staff. Great idea, not going to work. Those conversations are totally different now under the current environment than I have seen them, in the last 3 years that I've been here. So I am enthusiastic, cautiously enthusiastic, but I do see a lot of people willing to try and do what's right.
Well, Aaron, there's been a lot of positive comments that have come in. Just one broad question here, just because we've been talking about the plan, but just a little bit of context on what set this plan up, and there's a little bit. So just if you could give a couple of the drivers related to this big plan that was released today.
Well, when you say drivers as to where we're going,
well, not just even just saying just what was the impetus of it. It was how this all gets started. The request for the strategic plan.
Yeah, I think originally, once the legislation was passed, I think IRS started down the path, but the Secretary of Treasury, came out publicly and asked that the IRS develop this plan. I can tell you there's been a lot of people. So I'm currently in 1111 Constitution, in what we call the headquarters or national office building. I've not seen so many people in the 3 years that I have in the last few months. There's been a kind of a buzz throughout the building. And so they really have gotten all organizations together to give sort of their 2 cents. They have a lot of initiatives that you're going to see throughout the plan. I think there's over 40 some odd initiatives and a lot of projects. And they're leveraging, yay for TAS, we've given a lot. A lot of our executives and employees are part of these initiative teams, so we're giving for the greater good. But a lot of the business units, the same thing. They're donating sort of their people and time in order to get this implementation through. So it's been a real team effort watching what the IRS is doing.
Well, thank you very much. I want to bring a slide up just kind of for you to highlight some additional resources for the town hall attendees to take advantage of. And we've had a number of questions about how they can get access to the strategic plan. We'll clearly provide a link in our follow-up newsletter to everybody so they can get it directly for themselves as well. But anything you'd like to highlight here?
Yeah, I mean, TAS is what we kind of call the safety net. So if you are having problems with your particular taxpayers' clients and you cannot get things resolved, please reach out to us. If you go onto our website, we have a kind of a who to contact, which will tell you your local offices, phone numbers, emails. I'm pushing for our folks to continue to use email, so FYI. So it'll be easier to get a hold of the local offices. So we are here to help. And I think there's been a misconception that we only represent taxpayers. No, we assist practitioners in helping those taxpayers as well. So if you have clients with issues and you qualify for our service, please reach out.
Well, thank you, Jan. Thanks for being with us again on a town hall. And Aaron, this is your second town hall. We look forward to having you back again as well. Thank you very much.
Thanks.
Thank you, guys.
Thank you both.
Okay, Barry, before we're going to get into just an update on kind of some of the outcomes or discussions that are going on related to the banking situation. But before we do that, is anything that you want to comment on about, you know, the letter that the AICPA put out before this strategic plan came out? I know we're right now all reading it and we're going to maybe looking at it in comparison to some of the recommendations that our team made.
Yeah, and Erin did reference that. Look, we focused on, I would say, 3 areas. We focused on the service element, which in our comment, with a whole lot of recommendations where service needed to be addressed and needed to be modernized and all of those types of things. Obviously, as she spoke, we talked about you have to get the backlog down. You have to quit doing this, what I call the self-inflicted wounds. You know, we also have come forward separate and apart from that letter with our proposal on how to deal with the tax extension process, where we can create, and it's going to take legislative effort, but we want to create a safe harbor on a tax extension so that the calculations don't necessarily need to be made. That consumes a lot of energy in offices or, you know, CPA offices around the country. And we have a very significant proposal. We talked about that on the last town hall. And we will be, you know, bringing that to Capitol Hill in May as we really try to get people to focus on how these self-inflicted wounds or this consumption of energy can be pulled out of the system to make the system flow better. And then the third element that we talked about was sort of in a broad bucket of operations, which tied into technology. We've been talking about that on town halls for a long, long time, since we've had town halls, really. And it takes that technology investment. I think the commissioner is well positioned to be able to execute on that. It won't happen overnight. It's a big, bodacious set of issues and challenges, and that's why it's so important to find these practical solutions, eliminate these self-inflicted wounds, you know, these automatic notices, and the whole process that just continues to bog it down. And so we've tried to knit those things together, including going so far as bringing some legislation specifically on the extension side. So I think from what I've seen and read, and as Jan said, it's been a quick read, but you know, they're trying to address those issues. And I think our members can rest assured we will continue to be discussing the specifics from an implementation perspective as you move from the strategy to the actual plan points in a plan.
And Barry, there's a number of questions coming in just related to how much talk has been around enforcement, the percent of the 80 billion that is on enforcement. And just want to highlight, and you know this well, that, you know, this is a point that the AICPA letter, you know, brought up, you know, the concern of the allocation of 45 billion for enforcement and only 3 billion for service. You're hearing from Erin just now, she's talking a lot about this is somewhat a fresh look at how to reinvent the IRS. So those points are being made, and you just
Yes.
made it again.
Yeah, and look, they have to find a way to move that money from enforcement to the operations side, and we've talked about it on town halls. There's this conflict here of the budget estimate of how much this enforcement spend can produce in additional revenue, and sort of the pledge to not affect lower income people. And the reality is that we all understand the system, and that the higher income people, it's, there's so much automated and information flows already that are connected. It's a lot harder to deal with that. Yes, there may be some things in the corporate space, and certainly there are things with fraud, but it's a very tough spot. We talked about the rock and hard space from the standpoint of the ERTC and our practitioners. I think the service is in a hard spot, saying we're not going after lower income players, but we intend to close the tax gap very significantly. And the reality is that probably skews to lower incomes. And so it's a tough political issue and a tough pledge that I think will have to be worked on as the months pass.
Well, Barry, let's now just pivot and talk a little bit about what happened last week, and continuing discussions in Congress related to the banking failures. What happened to SVB, Signature Bank, and both the House and the Senate, had a number of the regulators in front of them to kind of inquire, why this happened last week.
Yeah, I think the debate really has shifted to the regulators, as you just said, Eric. I think that's where it currently sits. Clearly, early in the process, there's partisan finger pointing about whose administration is responsible for what, and and what is the cause and effect. And clearly accounting comes into that space, and auditing comes into that space. But I've spoken, at the previous town hall about the amount, at least for Silicon Valley Bank, about what on the face of the financial statements disclosures were there, and additional disclosures on the maturity of U.S. securities, essentially, and the weighted average yield that was in place, which was very low, and how that leveraging really got out of sync. And then you hear people point to the hold to maturity accounting rules, and should that change. I think the SEC was very clear, and probably with the support of other regulators, was very clear in the last week or so, coming out and saying, look, the fair value rules as they work today with banking, which there's a piece of mark to market and there's a piece to hold to maturity, which is held essentially at cost, but with very, very pointed, on the face of the financial statement disclosures that people can see, users can see, investors can see in that information. I think that's the tenor of where we are today. Now, it's easy to say that today. You can read articles. Everyone on this town hall reads articles about people predicting and where short sellers are and things of that nature. I think how this continues to evolve will dictate what the tenor of these discussions will be. But as it sits right now, I think the main focus point has been in the regulatory community. And I think there'll be other hearings, and that will be broadened to some degree. But the height and the intensity of it, I think, has really focused in that area.
Yeah, and as the fog lifts on what happened, I think Jamie Dimon sent out their annual letter, and he summarized it well. He said these issues were hiding in plain sight, and he also kind of commented on how it wasn't the finest hour for many players. So clearly, the banking executives have accountability here, but there was other breakdowns in the system. So this is.
And Eric, I'll be real quick. But you and I had this conversation about the importance of the community banking system to our economy, to the small business part, to what a lot of our town hall participants is who they work for and who they, provide services to as clients. I think it's incredible that we are a voice to make sure, and obviously the banking community needs to be a voice too, though, about the essential nature of community banking to our ecosystem in this country. And I think that can't be something that is an unfair outcome in this process.
Absolutely not. I mean, more and more firms are providing the client advisory services, the outsourced accounting services, supporting a lot of those interactions between the payments and the clients, and the regional banks play a critical role. And there's lots of ways to still manage risk with a properly set up platform. So I think this is something, post tax season, we probably will get into a little bit of the practical advice related on how best to kind of support your clients, but the regional and community banks play a critical role. So Barry, this slide's got 2 bullets. You could put many bullets here on that other ongoing hearings. There's a lot of debates going on right now on the Hill. Obviously, it's getting more partisan with some of the events that occurred this week, and this all plays into the debt limit.
Yeah, and sort of to the second bullet, let's just remember everything you hear about being talked about is people saying we're going to do this and do that. Let's be the voice of rational thought as CPAs with our clients and our employers. Very few of those things actually become reality, and we have to remember that. And I talked about that on the last town hall. People throw out things and make statements, and the media covers things in certain ways that seems like this is happening when in reality a certain outcome is not happening. Now, the debt limit is one that we know is in front of us, and it is highly politically charged. The Biden administration has said we're not dealing with the debt limit, the Republicans in the House, in any context about spending. You give us a clean answer. And of course, there's a lot of members of Congress are saying, we're not going to give you a clean answer. And therein lies a very significant element of discourse that's going to occur over the next few months. And there's still debates as to when the X date is, the date where there's a cash flow problem. There's a piece of legislation pending on the debt limit that really prioritizes spending or really authorizes Treasury to prioritize spending in a certain way in basically 3 parts. One part is default provisions to not default on obligations of the federal government, and senior protection. So that's sort of the makeup of the major element of, part 1. Part 2 is really, the other things that would get prioritized by Treasury, but that are that need to exceed before all other obligations. So there's a bucket that is not yet defined, but it's intended to reflect that not all expenditures are the same. And then the third bucket is an interesting notion that it deprioritizes for Treasury from paying specifically noted items unless all other obligations of the federal government have been already met. And those include payment for government travel, compensation for official union time, and compensation to the president, vice president, executive branch appointees, and members of Congress. And so they've deprioritized that in that bill. Now we'll see if it gets passed, or we see if there's some compromise on the spending. But we got a budget bill. We've got a polarized Congress. We got one side saying it's not about spending, and we got another side that says it's a heck of a lot about spending. And it all gets wrapped around to where is the sufficient cash flow, if you will, from the federal government to pay our national obligations.
Well, Barry, we'll be continuing to watch this as it progresses over the coming months and summer. Another item that is on the schedule this month with the SEC is related to ESG, the disclosure draft that was issued last spring, I think. And as we know in DC, Mark Peterson has said this many times. I mean, things can be scheduled and they can occur, or they can continue to be delayed. And there's also discussions related to what's going to happen with this final position.
Yeah, I'll be very.
I want to give a little bit of background, Barry, just on.
Yeah, I'll be very brief on it. I mean, it's a very all-encompassing exposure draft. 15,000 different comment letters. I think the highest ever for the SEC. And there's certainly been reports that the SEC is taking a hard look at what's in the final rule based on that feedback, but also wanting to make sure it minimizes its risk from a legal challenge perspective. There's talks about, it's coming out in April. It's going to slide to June. It's sort of your point. It's nothing's final until it's final. And there's also some things that have been attributed in some media to the chairman about scaling back what's called Scope 3. And Scope 3, again, for our town hall participants, would probably be most interesting, because Scope 3, if you have a client that is a reasonable player in a supply chain, and if that supply chain incorporates, for instance, European situs, there are going to be requirements that cascade down even to private companies, depending on how that gets enacted. And so there's talk about scaling down the Scope 3 in the U.S., and how that plays out with Europe is to be, to be determined. I think it's a very fluid state. I think there is a lot of pressure and desire to do something by the SEC. And, I think you have to commend the SEC if they are slowing it down to figure out, what's the right answer here. And so I think it's probably not imminent, and we'll see it. We'll be talking about it in future town halls.
When it breaks, we'll cover it here on the town hall. So Barry, we're going to bring you back during open forum, but now we're going to bring Carrie Hipsack up to provide our technical updates. So Carrie, it's great to have you. Welcome.
Thank you, Eric. Appreciate the welcome back to the town hall. I have a few technical updates to share with everyone. I know we had a lot of tax conversation with Jan and Aaron earlier, but I just have a couple of tax items to highlight as well. If we start with the first topic, it is our newest ERC resource from our tax team. We continue to get a multitude of ERC questions, in particular from the town hall, from town hall attendees through our team inboxes as well. And our tax section is aiming to be very responsive to all those questions. This newest podcast just released today, somewhere between 11:30 and the start of this town hall. So this is brand new. This is a podcast with April Walker about ERC and professional responsibilities. April talks with Dan and Chris to share insights about what they're doing related to notices from the IRS and the OPR, which is the Office of Professional Responsibility. And next, we have just a quick reminder of some of those resources that are already in existence for our members. The first that I want to point out is the Employee Retention Credit Factor Fiction. That is designed to be a resource that you can share with your clients. So don't feel that it's just for practitioners. It can help address some of those client questions as well if you would like to share that with them. Next, I want to touch on a 1099K resource. We had a lot of discussion about 1099K during the last year, and this is a nice high-level, plain English, easy to read document that, again, practitioners can go ahead and share with their clients to address some of their high-level questions. This is not currently available on the website, but we did include it as a download on today's town hall. So please make sure you go ahead and download that before the end of the town hall, so you'll have it available since it's not currently online. You all get a little bit of a preview of what's to come on that. It's just, like I mentioned, a quick review of 1099 for the calendar year 2022. It will, the trigger threshold, I should say, will remain at a total number of transactions exceeding 200 and combined payments of greater than 20,000. I know during the year we had some debate about this going down to 600. Our advocacy team at the AICPA is still involved with this to keep the threshold possibly a little bit higher to a more reasonable threshold so that Form 1099Ks aren't triggered all the time. This does, again, like I mentioned, take a high-level look at some common 1099K questions that might be very beneficial for your clients. One of the questions, I should say, that I've highlighted here is what happens if I receive a 1099K in error? And then a second question that your clients might be asking is, how do I prevent personal transactions from being reported on a 1099K? So this, again, is a great resource to go ahead and share and hopefully curve some of those questions that might come to you about 1099K. Next, I'd like to move on to some A&A topics by taking a look at one of the most recent accounting standards updates issued by FASB. This was released last Monday, March 27th, from FASB, and it relates to leases, specifically common control arrangements. A few months ago, FASB released an exposure draft requesting comments on this topic, and I know we had some questions in the town hall about that. And now that we finally have the ASU, I would like to go through some of what was determined from that process. And the first thing I want to mention is that one thing that the FASB does is what's called a post-implementation review process, where they look at an issue, or a standard that's already been issued, and they go back and they take a look at what might need to change. So there were two issues that were identified with the leases ASU. The first is that Topic 842 requires a determination of related party arrangements between entities under common control being a lease. And if it's yes, then they must classify and account for the lease as an unrelated party, This matters because counting for a lease as an unrelated party is on the basis of legally enforceable terms and conditions. So I really emphasize legally there, because this can actually be the problem that makes it very difficult and costly. And in some cases, you might even have to obtain a formal legal opinion. In this update, we see a practical expedient for two groups of people. The first is private companies, and the second being not-for-profit entities that are not conduit debt obligors. So when we move on in this topic, we see that the practical expedient allows for the use of written terms and conditions. So it's not that legally enforceable terms and conditions that might require an outside legal opinion, but instead it's what is actually written. And then you use these written terms and conditions to determine if a lease exists, and then the classification and accounting for that arrangement. I do want to point out this is not a blanket expedient. It is applied on an arrangement by arrangement basis. And unfortunately, if an entity does not have written terms and conditions for a lease, then they are prohibited from applying the practical expedient. Moving on to issue 2 that was addressed with this latest ASU is in regards to leasehold improvements. Topic 842 requires leasehold improvements to be amortized with the shorter of the remaining lease term and the useful life of the improvements. Private company stakeholders pointed out that doing this can in fact result in financial reporting that's not the most faithfully representative of the economics of the leasehold improvements. It was also pointed out to FASB that depending on the salvage value, accounting may fail to recognize the transfer of value between the common control entities when the lessee no longer controls the use of that underlying asset that has the leasehold improvements. And finally, FASB did note that there was some diversity in practice that they wanted to tighten up. On the next slide, we will see the amendments that had these 3 results. I'm not going to read through them all, but if you would like to go through them and read them in more detail, you can check them out here. And of course, we do have a link back to the ASU, so you can look at all those details as well. I do also want to point out that leasehold improvements are still subject to impairment in the codification topic 360, property, plant, and equipment. So the gap improvements, when all was said and done, is that this clarifies accounting for leasehold improvements in those scenarios that are associated with common control leases. And it does provide investors with financial information that better reflects the economics of those transactions. And last but not least, when is this all effective? The amendments in this update, or ASU, are effective for fiscal years beginning after December 15th, 2023. And this does include interim periods within those fiscal years. Early adoption is permitted, and if an entity adopts the amendments in an interim period, it must adopt them as of the beginning of the fiscal year that also includes that interim period. So we had a nice balance, I'd like to think, of some tax and some A&A updates in the technical section today. And Eric, I will turn it back over to you to run the show.
Well, thank you very much, Carrie. And we're now going to move into open forum. So let's bring the whole team back. That was well done, Carrie. A lot of information in those technical updates. And we had some fans out there saying that they really appreciate FASB releasing this right during tax season. So,
yes, well, it'll be waiting for them, and it will still be there after tax season. So thankfully that document can be read at any point in time.
Well, Barrett, we'll move to a couple of tax questions, but just there were some questions that came in as we discussed the banking situation, and you did a really good job covering this on the last town hall. Just some questions about the audits around these banks, and as we were saying, a lot of this information was in plain sight, even as you read the audit reports. But maybe just a couple of comments related to the audits.
Yeah, really focused on the Silicon Valley Bank, just because that was maybe the catalyst, if you will. The issue of how that bank's investment portfolio was invested, which was, I think it's 94%, was invested in greater than 10-year maturities. That was clearly disclosed. And the accounting in a banking situation is if you intend to hold to maturity, you essentially are recording it at cost. And on the face of the balance sheet, in the wording on the line, it talks about what the actual fair value was and how, in effect, underwater that number was in that process. So, I think there's a pretty strong belief that the audits really accomplished what was supposed to be there, which was to create a transparency of information related to what the substance of these transactions really were. Now, that's not going to stop, people questioning it and being critical of it. That's the nature of auditing. We've lived through this many, many times where there's economic downturns. We can go back into the, into the 80s and with the S&L crisis. We can go before that with a banking crisis before that, and certainly WorldCom and Enron, et cetera. And what we find ultimately is some of those situations are not audit related at all, and some they are. And we can go back to the Madoff era, 2008, in which I think we had a major breakdown. It was major fraud, but it was obviously deemed not to be, a significant audit challenge at that point. So I think that's out there. By the way, just a little bit of jovial, because that's a hard question. I don't actually want to know this answer, but it would be fun to know, because as we're doing this town hall in the midst for all of our golfers at the Masters tournament, how many of them are actually watching the Masters while also listening to the town hall? So. I'm
sorry, they're not allowed to double tap.
Yeah,
But that's one of the town hall rules. We ask them we really appreciate their full attention. Barry, but also the run on the bank was very unique. I mean, that's without the $40 billion, what happened all of a sudden. So you could say they absolutely could have supported $10, $20 billion in withdrawals. When it got to $40 billion, that's when the run was just too great.
It's really the first social media driven run on the bank. If you want to think of it in the context of history, right? We've learned in history about runs on the banks, or we've seen them in other countries and things of that nature. It's really the first social media driven run on the bank. And, what are the implications of that, and how do you deal with that? I think is a really interesting set of facts that as a country and as a society, I think we're going to have to deal with.
Hey, Jan, so a lot of good positive comments about Aaron's presentation. Any kind of key takeaways for you?
Well, I'll just say, as a tax practitioner, if I were sitting out and listening to that today, and then I go read the 150 pages, I think one comment I would have is that it does not appear that there's a lot of details. There's a lot of pages, a lot of strategies, but not a lot of details. And that'll be a little frustrating for some of us who are very numbers-driven people. I think, secondly, while this gives us some hope, I hope our members know the AICPA tax team will not rest until we have our point heard about the enforcement and the balance of funding. Taxpayer service, the backlog is critical. We're not stopping. This report doesn't change any of that. And I think this report really shows that it's going to take quite a while for there to be real improvement. So we're not going to stop. We will continue to look out for our members and for taxpayers. That's what we try to do. So yeah, you can go read the 150 pages at leisure, and it'll still be there after April 18th as well.
Well, Jan and Carrie, ERC questions coming in. I mean, someone said that some of their clients are saying these are AICPA kind of validated ERC filers. So, I mean, obviously there's no such thing as that. Clearly just want to note that. And then also, so Carrie, you can comment on that. I'm sure you've heard that as well. And secondly, just the myth or fact or fiction FAQ that we have. Is that available to non-tax section members?
Oh, I feel like I'm really put on the spot here, Eric. It is available to tax section members only. Okay. That is one of the many benefits provided by the tax section. I understand maybe not everyone on this call is a tax section member, but if you are deeply ingrained in tax services and this is something that could be helpful to you, then I highly recommend you check out all the other tax resources, because this is just one of many that can provide a significant value to practitioners.
Okay.
And the Tax Section Odyssey podcast that Carrie mentioned earlier is a perfect example of information that's out there for all CPAs, practitioners, anybody that wants to listen to that podcast. And we talk about ERC a lot in that as well.
And for the town hall attendees, I know we did cover this on a previous town hall. We can maybe highlight that in the upcoming newsletter where you can get Lisa's review of that. Well, Jan and Carrie, Barry.
I was just going to say, I just want to reiterate your point on that. We don't certify people to be ERC or certify people to be doing any of that. And, the only mechanism we have is that if we find it, we will take as much action as we can to stop them from doing it. But you can certainly communicate that to your clients.
So Carrie, Jan, thank you. Look forward to having you back with us sometime soon. And Barry, I'll just with you quickly review the final slides here. So here's the in summary slide, a lot covered today. Thanks again to Aaron Collins for joining us. Hopefully most of you know about the AICPA and SEMA Engage conference. This is the flagship conference of the year, 4,000 plus people in attendance. So that's June 5th to the 8th. You can find out more information at this URL. Here's the most recent Town Hall on Demand archives. And just as importantly, Barry, this is a slide we've been showing the last couple of weeks. We're counting down to number 100. So the next town hall, we did say it was April 6th. The next town hall, Mark Koziel, who helped launch the town hall series with us 3 years ago, is coming back in his new capacity. He's the executive director of Allennial, a large firm association. He'll be with Rachel Dressen, who represents our DC team. We then have Tom Hood and Dan Hood. Dan Hood is the editor of Accounting Today. He's going to be providing a review of their most recent top 100 firm publication that they produced. And we're going to have Steve Leisman, who is a regular on MSNBC's Squawk Box, and he's going to help us unpack, where things are going related to rates. He really does tremendous analysis on what's going on with the Fed, and he'll be sharing that with us. And then we're going to move to the 100th town hall. And just coincidentally, Barry, we didn't plan that, but that's going to be at town hall. Not at town hall, at Engage. Right. And you'll be with us with Kimberly Ellis Taylor and others. So any final words here for the listeners as they close out tax season?
Well, I'm hearing from tax practitioners that it's, you want no one will ever say it's a great tax season, but most part, the feedback we're hearing is that it's better. And of course, the tax section will have its survey. So please respond to that after April 18th. And the only reason why there'll be 100 town halls is because of all of the participants and the incredible attendance that we have. So we know you're seeing value in it, and we're motivated to continue to do that. But there's 100 because of you. So thank you for being part of it.
Thank you. That's all for now. See you on April 20th.
Thank you for your participation. You can now subscribe to the AICPA Town Hall series on your favorite podcast platform, as well as watch archives on YouTube and AICPA TV. Tune in for live broadcasts Thursdays at 3 p.m. Eastern Time.